We've been in a circumstance going back to certainly 1982, where inflation has subsided. Corresponds with the great bond bull market. The yield that the U.S. government had to pay to get you to loan them money for 10 years has fallen from 15.6% to 2%. So inflation is out of people's minds. People haven't been schooled to be nervous about inflation, particularly those few people in the world who happen to be younger than I am. They've never experienced that circumstance. Two, we have just lived through the most benign financial time in human history. Major equity indexes have gone crazy. The bonds have gone absolutely crazy. And so people have been taught to believe that the big thinkers, governments as an example, have the circumstance under control. 2008, well, they fixed it. The 2000 tech wreck, well, they fixed it. COVID, well, they fixed it. But every fix, Carrie, came at a price. Every fix reduced their ability to fix the next one. I would argue that the circumstance that we're in today is not one where the world is solvent, but one rather where the world is liquid. And liquid and solvent are very different circumstances. And I think that people's opinion of the risks of inflation will change. I was speaking to a younger person. Of course, most of the world is younger than me today. But I was speaking to a younger person last week about 4.5% inflation. And he said, well, 4.5%, what does that mean to me? And I said, well, what it means to you is that if you have your money in a savings deposit getting 10 basis points in a currency that's depreciating by 4.5% a year, in 5 years from now, you will have 40% less purchasing power than you have today. How would you feel about that? In effect, that's a tax. That's something to worry about. Australians won't understand this reference unless they've been to the United States. But there's a motel chain in the United States called Motel 6.
Oh, yeah.
And it's called that because when I was a young man, a room at Motel 6 cost $6.
Oh, is that right? I did not know that.
Yeah. Given my economic circumstance then, Carrie, I had more than one occasion to avail myself of a $6 room at Motel 6. The other day, I drove past a Motel 6 up here where I live, and it said Motel 6, $79. Now, there's only two explanations for that. One, a room at Motel 6 could be 13 times as nice as it was when I was a young man, 13 times the size, 13 times better sheets, 13 times better appointments. Or the denominator, which is to say the currency that purchases a room at Motel 6, could have declined by an equivalent amount over the last 40 years. I'll leave it to you to decide what it is, but my suspicion, not that I've had to stay at a Motel 6 recently, is that it's very unlikely that a room at Motel 6 is 13 times the size or 13 times as nice over 40 years. I would suggest that it's a decline in purchasing power. And that's a truly pernicious decline in purchasing power. The US dollar, measured by a room at Motel 6, has lost over 40 years more than 80% of its value. And that's the perniciousness of inflation.
If I can just ask you this, because does it matter if that price has gone up, if wages have gone up, and if everything, the rising tide raises all boats? Does it really matter? It's $6 then, it's $79 now. When I was growing up, my mother would give me 5 cents, but she was earning a few dollars, whereas now it's hundreds of thousands of dollars, and the numbers are just outrageous. No one cares.
Our mutual friend Bill Bonner has done a lot of work on this. And Bill measures the number of hours it takes the average worker to buy him or herself a home. It is true that homes are nicer than they were when I was a young man. But that style of home for that price relative to hours worked is no longer available. Similarly, the number of hours per year that a worker must work to buy himself or herself a car. Now, I realize that some of your listeners probably take the bus or take transit or something like that. But for most people, a car is relatively constant form of transportation. And the fact is that it takes the average worker 3 times as many hours to afford an automobile. Now, yes, it's a nicer automobile, but the less nice automobile isn't any longer on offer for the same number of hours per year that were worked. Probably, Carrie, the most pernicious example is the number of hours per year that you and I work to fund federal, state, and local government. It's interesting to note that when either Australia or the United States publishes the Consumer Price Index, they don't include tax. Now, I suspect if I didn't have to pay the tax, I wouldn't so much about the index. But the truth is that that's not on offer. And I suspect that all of these things put together are going to change the inflation dialogue. I think, too, that 4.5% is a starting point. I suspect that any time that there's a financial crisis, that the government will respond to the financial crisis by more quantitative easing. And by more negative interest rates, which will stimulate more consumption and more speculation, which is to say that I think that 4.5% will be a floor rather than a ceiling. But it doesn't matter. You don't need to project higher inflation. All you have to do is hold the 4.5% inflation rate constant against the cost of capital, which is to say 1.2%, and understand that as a saver, you are getting slaughtered in conventional savings instruments. You're not getting hurt, you're getting slaughtered.
Is that why the stock market, because everybody's, and I introduced you right at the beginning as investor and speculator, do you think the speculation is what's driving these share markets into all-time highs?
Well, 2 things. On investment quality stocks, what you are looking at is the dividend yield relative to other savings products. All of a sudden, equities are paying more than debt. That hasn't happened since the very beginning of my investment career. So people perversely are drawn to bonds for capital gains as they lower the interest rate, and they're drawn to equities for income. But the second thing is that the very high equities prices and the very low price for debt for investment grade issuers means that companies' costs of capital are much less. If your business is funded 50% with debt, as an example, and your net interest charges falls from 8% to 3%, you're saving 500 basis points in cost against 50% of your balance sheet. So companies have enjoyed a tremendous earnings boost at the same time that those earnings are valued at a different metric than they would have been at higher interest rates.
Does the circus continue, or in Rick Rule's world, is there going to be a moment of truth reckoning and a come to Jesus moment?
Carrie, because I'm by nature a credit analyst, a lender, I always assume that every circumstance out there exists just to screw me. And consequently, I'm very cautious. Doug Casey and I joke that between us, we've called 17 of the last 3 declines. And I'm always expecting what you would describe a religious experience, a reckoning. I would be surprised if sometime in the next 5 years we didn't have a black swan style liquidity squeeze. Whether it will be as bad as 2008, I can't tell you. What I can tell you is that every time we've experienced one of those in the last 40 years, the answer has been to pump money into the system. And eventually, the efficacy of liquidity as a tool declines. When you stimulate the economy by pumping excess liquidity into it, what you really do is forward shift demand. You take demand that would have occurred in 2023 and you spend it in 2021, which is great in 2021, but in 2023, you need to replace it somehow. And my nervousness is not so much that we will come into a circumstance like that, because we've come into them several times before in my career, but rather how do we exit them? What tools will we have left if we have exhausted, to some degree, the stimulative impact of negative real interest rates and quantitative easing? That's the thing, if anything, that keeps me up at night.